Welcome to Trends with Benefits, a podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, investing, work, and life. Here's your host, Ed Lopez.
Welcome to another episode of Trends with Benefits. This episode, we wanted to explore the idea of the individual investor and the rise of the individual investor, and in particular, investor engagement on social media platforms and the role that they play in driving sentiment. And fortunately, I have been able to welcome back to the podcast for a second time, Howard Lindzon. He's a notable investor, entrepreneur, and founder of Social Leverage, founder of StockTwits as well. And that's where I'd love to be able to kind of start the conversation. And then we'll get in and talk about Slack is SPAC.
Slack my SPAC.
Welcome, Howard. This year has been remarkable for the attention that the individual investor has gotten. I guess really over the last year, really since COVID, it's really kind of been building. But January, February really kind of shone a spotlight on it. How would you characterize the growth of the online platform for the discussion of stocks and investing in general?
Well, I mean, listen, someone who's a 12-year overnight success or a 20-year overnight success in this space, what the hell took so long would be my answer. I grew up probably like you. I'm in my 50s now in the markets. As a retail investor, we had this explosion of this Cambrian explosion with the internet in the 90s. And we had E-Trade, Daytech, Yahoo Finance, Street.com. And we used to congregate on Yahoo message boards. So that was the original StockTwits, Twitter, Reddit. Yahoo Finance was all of that. And guess what? 20 minutes delayed on your data. And you think that was like nirvana, just being 20 minutes behind the institution. So you had 20 minutes delayed data, and we still were trading our eyes out on E-Trade and Daytech for whatever the trades cost at the time. And they were a lot. And the spreads were what? Today, what happened is there's three types of social media. We've gone from 20 minutes delayed to living in the future. You can live in the future for free. You can go into the wilderness of the internet, and if you know how to curate it, you can see the future. So you live in the future, you're in Reddit. You want to live in current real time and engage in real-time scrum of the markets. There's Twitter. And if you want to be just a tiny bit delayed, sometimes real time, sometimes 20 seconds delayed, sometimes a minute delayed, and just get it curated a little more, you go to StockTwits, which is like, we're on Twitter. It's all the people who are on Twitter and Reddit who love stocks are on StockTwits, and maybe it comes a minute late, maybe it comes 30 seconds late, but it's curated by someone who you trust, who reads Reddit and who reads Twitter, right? And that is why it's so popular, because we went from 20 minutes to living in the future, which is too hard for most, to Twitter, to StockTwits, and now the future, which is going to be tons more of this. You have Telegram, Signal. You have these chat products where people can form groups now and take all this information and trade off of it.
And what benefit do you think people get from it? Is it just, I guess it's the information that they need to trade, or they feel like they need to trade?
Yeah, I mean, it's the name of our firm. I'll go back and I'll explain to you the epiphany that I had. 2007, an end of an era came. 1999, the bubble came. 2007 was the beginning of the end of what I call financial leverage, right? And that was kind of like Web 2.0 was just starting with YouTube. And so everybody was doing homes and leveraging their home. And you had 12 homes and your dog had a home and everybody could get a mortgage or 10 mortgages. And we saw the end of that. And that won't come again in our lifetime because of these. That led to the boom in digital currencies and PayPal and Square and all these fintech things coming to kind of decentralize what Goldman and all the Fed and everybody was doing. And they're going to keep doing what they're doing. I'm not going to judge that because you still have the Fed and you still have Goldman Sachs at all-time highs. But you had this era that I call social leverage, which when I started my firm with Tom, we said, wait a minute, my network and my social graph is the leverage that I need, right? These companies can be started with very little money. You can use social media, Twitter, YouTube, to meet everybody in the world. And so we replaced this financial leverage with this speed era, which I call social leverage. As good as your graph is, you and I chatting in our networks and get on Zoom and do a podcast or do a TikTok or do a YouTube video, So it's this era of social leverage where all this stuff is getting done despite the government's ineptness, despite the fact that half the economy is not open. So this era of social leverage is just getting going. And really the downside of social leverage is if you don't have a network and if you're following the wrong group of people, you're really screwed. If you have the right social leverage or the right peloton, as I call it, you can keep up with anybody. But it's not in the know, and the know is free because it's just who you follow and when you decide to follow them and how you just engage with those people. You really are behind the times. And so that's how the world has changed from that era.
You see StockTwits as a place to get general ideas and long-term trends to really influence an investment strategy? Is it more entertainment for people? Has it evolved over time?
It's a great question. I would say we haven't raised the hundreds of millions of dollars. Profitable business, maybe 25 employees, growing very fast. And we didn't have the luxury that Twitter had. There should be no stock. As I said, my original idea was twitter.finance.com. Take it from me, guys. I don't want to start another company. This is why we all use Twitter and yell at Twitter at the same time. It's like, God, you had it all. There shouldn't be Square. Square should be Twitter. There shouldn't be crypto. Crypto should be Twitter. Twitter was a protocol, a real-time protocol. That's why Fred Wilson, when he invested in it, he saw that like email, Twitter was a way of one-to-one communication, that if they had just kept it open and let everything be built on top of it, Twitter would be Square. Twitter would be StockTwits. Meaning, if Fred Wilson or Howard Lindzon's on Twitter and says, I'm buying Tesla, and Twitter had done its job well, you'd be able to click on that Tesla link, open up whatever brokerage you want, and buy your Tesla. That was the original idea that I had in 2007 when I saw Twitter. Here we are in 2021, and they're barely in the conversation as it relates to it because Jack went off and started Square because the board kicked him out, right? They didn't like my idea, and so StockTwits was built. And they didn't buy Robinhood or DraftKings. Imagine a DraftKings shouldn't even exist if Twitter was doing their job, because you should be doing your sports betting from Twitter because that's where all the real-time conversation, all the athletes are chatting. Shouldn't you be able to just lay your bet right from Twitter? So and this happens with all incumbents. We're seeing it now with TikTok and Facebook, Facebook even losing grasp and Clubhouse coming along. It is very hard in a technology world to stay the king, which is exciting in this era of social leverage over financial leverage. Everybody's like, Facebook's too powerful. Guess what? They're scared out of their pants with cryptocurrency. So the world is moving extremely fast right now. And I wish it wasn't, because it'd be easier to make money if it wasn't. But now you can't rest on your laurels like you did for decades in the financial leverage world.
Yeah, that's definitely true. I mean, just the explosion of NFTs seems like they've just kind of like popped up over the last few weeks.
And they popped up over the last few weeks, and I'll give you my take. In 1999, when you made fake internet money, and it wasn't fake to the people making it, I like to joke that you could go buy a Porsche. You would take your money out of the internet and say, thank you, Mr. Internet. And you would go buy real goods. You would go get a condo. You would go buy your home. You would go get your mama home. It was like internet people were like athletes. Go take care of your family. Go buy your first Porsche. Build a dungeon for all your toys. Whatever it was that you did with internet money in 1999, because it was crazy money. And the economy boomed, and then we crashed because there was no real digital economy yet. We were laying the bandwidth for what was to come now. This internet boom is very different. In 2017, we had the token crash. And anybody in the financial industry knew that was a scam coming because there's no regulation. Imagine me letting people sell my tokens to people in South Korea and Nigeria. Oh, that's not going to end well. And guess what? It did not end well. People got burned on a global scale buying tokens that were created in basements and through software. There was no regulation, there was no oversight, and people blew themselves up. But decentralization is such a powerful force that here we are a second time in 2021, and Bitcoin's now at all-time highs, and Ethereum is all-time highs. And these highways that are built on the blockchain, people have made fortunes. Not the amount of people that, in 2017, people made fortune and lost fortune. And the people that kept their fortune moved it back to the real world because they were scared. But only a few people kept it over on the digital side. Here we are in 2021, and even dummies like me have enough money in the digital world that will stay there. Meaning, I myself think NFTs are silly. I respect my money on the digital side of the world enough that I'm looking for lower risk ideas, not higher risk ideas on the digital side. I'm treating the profits that I somehow made in the digital world with the respect to say, I would like to take my risk from 20 down to 16, not take my risk from 20 to 45. And that's what NFTs represent. The money that used to come out in 99 to buy a Porsche and to buy a home, that same money is going to speculate. It's crazy to say this, but they are making so much money in that world that they would rather buy a digital shoe or art or highlight than a Porsche or a home. And it is mind-bending. It will not end well for those people, but they know what they're doing. And for those that don't know what they're doing, it's just like the internet. And so if you're missing that side of the economy, it's fascinating because it's not helping the real economy. In a perfect world where the government's understood all this, they would entice that money to come back into the real economy to be spent on goods. But because the governments are so screwed up and don't know how to collect money and are just not embracing the internet, and that's our fault as voters as well. This money is being pissed away in NFTs because people would rather say leave it there than pay taxes on it. So we are at this weird moment in time where the Fed is printing money on one side. The gold rush and decentralization has so much money pouring into it that people are doing stupid things rather than bringing it back to the real world. And so maybe it's a good thing. Maybe everything from here that's getting printed will go into the digital world, get pissed away, and we won't even have inflation.
Oh, that's a good point.
The money just stays over making software. So I can't imagine, I wish I was younger, a more interesting moment in time to be an investor.
So, we launched earlier, maybe a couple of weeks ago, a social sentiment ETF. A lot of it is based on scraping sites like StockTwits and Reddit and others like that for intelligence and investing. What's your take on that general idea of the strategy? You don't have to know the inner workings of it, but
strategy, I'm not sure because I can't comment. I know the people, obviously. I know Jamie at Buzz, and and by the way, you're not scraping, so everybody's paying for the data. So in the good news, like it's all legal. Buzz pays StockTwits for the data. Scraping is something that I know the hedge funds do, and I know the banks are doing to us all. And we know that Google does it. And the Russians do it and the Chinese do it. So scraping to me is like not paying for the data. If you pay for the data, as Buzz is doing, and as whoever is running these ETFs are doing, you're getting a clean data set. The suits aren't out to get you. This data set doesn't give you people's name. It just kind of is called an exhaust. Whoever buys it still has to put people on it and try and figure out what that data says. We're not handing people a holy grail of anything, right? Like the internet likes to make up stories very quickly about the suit. And, the evil of this and her taking our data. Yes, in many ways, if you give Facebook all your data, everything about you, your birth date, your interest, they will target you. If you're buying StockTwits data, you get nothing. You get an exhaust pipe with like mumbo jumbo, and it's up to a lot of people to figure out how to read that and does that sentiment mean anything. And if you handed it to 1 million people, 999, whatever the percentage would say, I don't know what to do with it. Other people feel that they can figure out what the granularity means. And Buzz is a really cool idea because if you believe in the internet, I like to say you should own Google. If you think the internet's going to get bigger, if you believe in the power of crowds and the power of sentiment, then the internet is the greatest place to go. Because like I said, Reddit, Twitter, StockTwits, you get all the flavors. And so Buzz is that idea, I imagine, that says, let's see what the internet has. And can we create a strategy that gets us 30 seconds ahead of the real world, 30 minutes ahead of the real world? I mean, in practice, it's a phenomenal idea.
Yeah, the idea is interesting, particularly looking at what the crowd is saying. But when the crowd is big enough, it also tends to attract bad actors, for instance, or bots even. One of the questions that comes up quite a bit is, well, what about bots, like pumping up different stocks on these different platforms? Does StockTwits see bots? Do they do something to kind of prevent their influences on the stream?
Yeah, it's a good question. Bots, it's a war. The internet is a war between bad actors and good actors. So the true real war right now is digital war. The reason why Cloudflare, $net, is such a great company is because it's fighting digital wars on our behalf to battle what they're called DDoS attacks, which is when everybody attacks at one time to a website and brings it to its knees. That's why Cloudflare is such a big company, and that's why cybersecurity continues to be such a huge industry. So we are constantly battling bots. Internally, StockTwits doesn't have tens of millions of dollars to fight these battles, but there's other software products that help us fight these battles. So we're constantly arming ourselves with software and humans and whatever to try and do it, and it's just relentless. They just never stop. So yes, part of what makes StockTwits special is we care about that stuff. But in real time, it's impossible. So it's up to the community and building tools to block people and report people and yeah.
How would you characterize StockTwits for financial advisors? Do you see many financial advisors on the platform? Is it all just individual investors? And how should they interact with their own clients that perhaps are on StockTwits and making decisions based on StockTwits?
So the world is moving very fast if you're an RIA. And we're about to see one of the greatest challenges to that industry. You have advisors getting older, you have clients getting younger. This money is going to come down at some point. And so left behind as always is financial industry, right? The RIAs do not have the tools. And if they want to have the tools, they're going to be regulated up the yin-yang, trying to do the right thing for their clients. And so now let's get to what doing the right thing is. Financial advisors spend most of their time gathering assets, right? And the financial industry did a great job saying, you go gather assets and we'll give you products that make sense. Package. It's like consumer goods industry. It's like Procter & Gamble. So the financial industry has become like a supermarket. Our registered investment advisor's job is to not lose their clients' money. Noble, I agree, for wealthy people, but that's not the world that we live in anymore. The new person has seen Uber. They've heard about Bitcoin. It's like we know that industry is lagged, and now it's never lagged by more than it's lagged. Because if you tell your 60-year-old client that they have to have 1% of their assets in tokens or in crypto or in collectibles or in NFTs, God forbid, there's no way it's worth the risk of the RIA to do that. And so for the swashbuckling RIAs, which I'm trying to encourage the early adopters to come over to the other side, we have to figure out ways to bring RIAs into the future so that 60-40 portfolio or that 70-40 portfolio of equities and bonds maybe becomes 60-38 and 2 or 70-20 and 10. We have to give people in a world of 0% interest rates, they have to take more risk. So I think it's the most interesting moment in time for this industry. And there's going to be massive disruption one way or the other. And so I'm excited as a venture capitalist. It's not a very sexy industry. It's not like I'm discovering gene therapy or inventing, the next internet or token. But
there's a lot of money at play.
Yeah, money is important, but it's also security. It's also fulfillment. It's also peace of mind, anxiety, all the problems that plague America because of marketing and money and what our neighbor does. They just happen to be very important. So I think it's still going to be a very important area for people like myself to focus on to help bridge that gap between financial leverage world and a social leverage world.
So talk a little bit about Slack, your SPAC.
The idea came from some really smart people. I grew up in Toronto and everybody had SPACs. SPACs were a way to allow speculators to drill for oil or dig for copper. It was a way like biotech before biotechs. It was how you got minerals and oil out of the ground, and you had to have people speculate. So they created these public vehicles that allowed people to take very big risks. And with big risk comes a lot of mess and some reward, of course, no doubt, but just a lot of people, as they would say, holding the bag. And so it's been this great mystery, a SPAC, of how to get public and raise capital. And it's finally evolved to be this product that, for many reasons, one being companies weren't going public anymore in the US, and everybody woke up one day and said, wait a minute, why do I own 500 stocks in the S&P 500? Why aren't these companies in my portfolio? And I'm not against indexing or the S&P 500, but like anything, the S&P 500, we're telling people to track something that's archaic. If you're not matching, the NASDAQ 100 the last 10 years, you're lying to yourself. You may, I'm not saying you're lying to your clients, you're lying to yourself. You're you're underperforming. Yes, there's more risk, but people have never talked about the QQQ until very recently. And I'm like, the NASDAQ 100 has been around 20 years. That is the index. Now, as everybody moves to say, I want to be all tech, yes, I'm really nervous about that. So now there'll be specialties within tech. And now there's the DeFi index, and there's the NFTs, and there's going to be indexes that make the QQQ look like they're for grandmothers. And so the world will continue to evolve. And this goes to RIAs too. They have to not lie to their clients and really explain to them how the world works on the risk spectrum, and really talk to their clients about what they can handle and what their money really will be worth if they stay back in the past. 7%, 8% compounded over 30 years is fantastic. Don't get me wrong. But they need to understand that there's opportunities out there to compound at 15 to 20%. Yes, there's more volatility, but they have to go out on the risk spectrum to explain to their clients it's not just a bond world and a stock world anymore. And that to me is fascinating.
And so what is Slack investing in?
So we can't say what we're investing in. Our S1. So what happened is the idea of the SPAC evolved. We are in the corner of the world social leverage where we write $1 million checks to startups, software companies. And I saw all these venture capitalists writing $300-400 million checks. And I was like, no different than me. I was like, I don't think they know what they're doing. And then WeWork comes along and we realize, yes, they don't know what they're doing maybe. And we've put SoftBank on this pedestal that says, let's give them $100 billion because Boston knows everything. Well, guess what? We learned that, like the Wizard of Oz, sometimes once you peel back the curtain, there's nothing there. And not that he's not a great investor, but there's a lot of shenanigans that go on when you put somebody on a pedestal like that. And so all this happens, no IPOs, SoftBank, T. Rowe Price, having all the fun. And SPACs get used. Chamath and some other people said, wait a minute, let's dust off this old feature of the stock market, the SPAC. Let's clean it up. Let's explain it to people. Let's remind people that these can be used to help you pick your investors, go public faster, make forward-looking statements. And so SPACs are just chaos. The internet doing its thing, entrepreneurs doing its thing, money doing its thing, where we have all this money printed. And that's really what SPACs are. And I said, give me some of that action. Let me go and see if we can do the same thing. So we went out with Barclays and Bank of America and raised $340 million. And we have 2 years to go merge with what we believe will be a very fast-growing e-commerce, fintech, or enterprise software company, and help build a great public company.
So last time we talked about long-term trends that you might see playing out over the next few years. I'd love to kind of touch on that again and see what's top of mind for you. What's on top of your mind right now?
Top of my mind is like what you asked earlier, and you got right, is the RIA is how do we bridge this massive divide between what RIAs are offering their clients and what's available to their clients? This risk divide, this education, this mentorship, this ability to, like VanEck is doing, offer these unique products. They, yes, have more risk theoretically, but also offer real returns in a world of 0% interest rates and deflation of inflation in money, but deflation in many other areas. The other thing that excites me is this idea of fees that was so long. Ooh, fees are evil. Fees eat into your returns. They really do. No question. Vanguard's fantastic if you want to make stock market returns over a certain, it's known to work. But it's still only 100-year-old thing, so we don't really know. And we really know in terms of the human life, but we don't really know in terms of centuries of investing. And this decentralized world of open source code changes everything. And so what interests me in this world is how this all plays out now. And that's like over the last 6 months when we chatted, that's a huge change for how I think about the world. And I can't keep up. So I've thrown up my hands and said, I can't handle the drugs, like the drug of the internet. And I need it to slow down, and it's not going to slow down for me. So fees are important now. Fees that have been beaten into people's head, don't pay 2 and 20, don't pay 2% for someone to manage your money. Those are, I think, incredibly short-sighted. It worked when the market was your choice and bonds paid a 6% interest rate. In a world where that doesn't work and the experts are now somewhere else in the food chain, you need to pay. That doesn't mean your returns are going to be the best, because someone's going to get paid a wage for explaining the internet to you and helping you get returns on the risk frontier. But I think this whole myth that hedge funds would die, it was a lie. They're more than ever. They may not be better than ever, but this idea that you should pay for someone to manage your money is something that I'm very bullish on. And it's not for everybody, but I think people that do this and understand the internet and dabble with all these new toys and understand DeFi and understand tokens and NFTs, or marijuana or space or robots, guess what? An ETF won't solve all your problems. And maybe it will, and you pay your 0.2%, and that's the way you want to go through life. But if you want to really live on the frontier, you're going to have to pay fees.
So I'm going to try something a little different. Instead of the trend or fad segment, maybe just ask you, are there certain trends or fads that you see that people should be aware of? We already talked a little bit about NFTs. I don't know, fractional trading. That's a major trend, for instance.
Major trend. And I think small is the new big. I mean, there's Kathy Wood. She's done an amazing job. And I think I personally would bet that we're at the tail end, and Kathy may be the last great messiah of this, of the large superstar manager, right? I think she's done a phenomenal job with her brand. I think if she was, there's just so much that could have gone wrong over the years. She's put in her time. She has great content, great transparency, yada, yada, yada. But like anything, all the money has flown in this year, or 80% of the capital. This is never a good sign. In a world of investing in technology like NFT, she can't get into NFT. She can't get into digital art. She can't do crypto at the size that should be to make the outsized returns. Big is dangerous. And I feel like, just like I say, paying a manager for returns is okay in 2021. I also think small is beautiful. Finding people with domain experience that can really dig into a domain is important. So I think that is a trend that matters to me in a world of this social leverage is find the experts. Don't worry if they're not 10 billion under management. Dig into the team, really understand what they're doing. And you got to develop, at some point you got to trust and take a leap. But I think small is the new big. And I think these market cap weighted ideas, while not going away and definitely have a place in everybody's portfolio, are not going to outperform like they did in the past. I think this younger generation is going to curate and pick brands and go smaller and have hundreds of wallets all over the place and not so much worry about owning the biggest and the best.
So what's the best way for people to connect with you or find you? You're on Twitter, obviously.
I think they should email you and you should curate the list for me.
Okay, I'll do that.
Yes. So it's easy to find me. I'm on the internet. My name, Howard Lindzon, right there, .com. So just screenshot it and just type in my name on the internet and you will find me. I'm on StockTwits and Twitter under the same name. Just add me. I'm generally, if you're nice to me, I generally respond. If you're not, I send it to my mother and she responds.
Well, Howard, it's been great talking to you again. Thank you so much for coming on the podcast once again.
Yeah, it was so much fun. I love the podcast and what you're doing with it. Thanks for letting me kind of just share my thoughts and blast them out there.
Yeah. Well, by the way, how's Panic with Friends going?
It's great. I mean, I get a lot out of it, Canute and myself. We're not great at marketing. We just hope that people find us. We've done 139 episodes now. We've gone to 1 a week, not 2 a week. It's just too much work. And we're really finding out what the audience likes. And we're, trying to take a silly and serious look at how to stay just like 30 minutes ahead of the world. You don't have to go 6 months ahead to make money. You really sometimes only have to be 3 minutes or 30 minutes ahead. So we try and put really important topics like we're talking about today and just repetitively talk about them and say, man, and find smart people who kind of live in the future and try and make it digestible.
Well, again, thanks a lot. Thanks for being on the show. And thank you for tuning in to another episode of Trends with Benefits.